So the market rallies up into that, takes the buy side out. Let me scrunch this up real quick again to show you. This was the buy side, right above that high. That means anyone short, they would have a protective buy stop there. But the 4-hour inefficiency up here, it's not just liquidity it's going to reach for. Because if it was just that, the market would just bump that high a little bit and then go down. It's not resistance, because if it was resistance, it would just hit that high or just a little bit above it and go down. It didn't do that. It went to where I teach you it's going to go. Price will go up for one of two reasons, okay? It's going to go up to take out a high or relative equal highs for the purposes of engaging the buy stop or buy side liquidity above that high or highs. Or, and in this case here, it does both, trades up to reprice to an inefficiency, which allows for engineering of liquidity. This high now, right here, there's buy stops starting right above that. I don't need a book map. I don't need a level 2. All that stuff, they are crutches. But level 2 is a gimmick. You can spoof level 2, okay? This was the draw that we were outlining yesterday live, okay? And that was the reason why I was saying I was going to go up there. But I wasn't limiting it to that. I told you to look past that level because I'm not a fucking support resistance trader. We go to it and through it. Where is it going to go, ICT? Up into this shaded area. How far can it go? We don't want to see it trade to the half of it and higher, because then it erases its effectiveness as a indication that it reached up there just to go lower. Because if it went all the way up here to close it, that's a little bit problematic for me. I want to see it go there and stop at or short of the halfway point. If it avoids going in the upper half of it, that's exactly the signature I'm looking for and requiring of that PD array. That 4-hour fair value gap, that shaded blue here, that very idea of it not getting to the halfway point or consequent encroachment of it, it failed to get there. That's what I liked about why I entered. What? That's exactly why I entered. Because this run up here, when it was running up there, it couldn't jump right to the halfway point. It stopped short of it. That was the very signature I was looking for. And on the very next 1-minute candle, which you watched me record live, it's happening right there. It's not market replay. Live execution based on everything I outlined in front of all of you live yesterday. There you go. If that's what we were running, the liquidity over here above this high, and we can frame how far past that high it can go, because we're not supporting resistance, we're not trading with that bullshit, we're trading into an inefficiency up here. So if I go back and I add, I can use those 2 candles there, thank you. I was wondering if I had to go back up to the 4-hour, but I can see I can use these 2. That's the halfway point, okay? I'm going to add the lower one there. So what I'm showing you is these are the 3 very specific levels. I don't trade in supply and demand zones either. That's not a fucking supply zone, okay? That's not a supply zone. It's not a supply zone. I don't give a fuck what anybody else calls it. That's not what that is. In this area here, in using this 4-hour inefficiency that's shaded off of a 4-hour chart, there are 3 very specific price levels. I'm showing them to you, okay? Now I'm going to go one step further and give you a chapter in a book on this very topic, okay? You don't want to be here too long? Get the fuck out of here. You want to learn? Get the fuck out of here. But this is how you're going to use this information, okay? Everything that I said yesterday live, everything that I was explaining to you, why and where it should reach to, this is the amplification of it. This is the part that experience was telling me I'm waiting for these very things. Midpoint, which is consequent encroachment of that 4-hour gap, okay? We and I didn't want to see it trade above that. So in other words, this is what we don't want to see. We don't want to see price trade into this area. This is the stuff people would pay money for, okay? Trust me. That shaded area there, that's not blue, when we are looking for it to go up, to go down, and it's trading into an inefficiency, this is the logic, okay? This is what the algorithm is doing. This is how people that understand what the algorithm is doing, how they engage with it. The smart money, the real smart money that are not going to be out here like I'm doing it. I'm rogue. I'm doing what the fuck I want to do. I don't give a shit. Tell me I can't, I will. Over here, prices trading above that buy side liquidity pool here. So in context, for you folks that want to screenshot stuff, so you're journaling. See how nice I am? I'm doing all the legwork for you. I know, I love you too. So it's going to the buy side here, but that inefficiency, that shaded area here, that's 4 hour, there are specific price levels, which is the low right here. It's trading to the low there, stops short at the low of what? The 4 hour inefficiency. That's fucking random. Then the next candle, it does what? It trades up into the lower quadrant, but watch, fails to get to that halfway point. Beautiful. Woo! That's exactly what I'm looking for. I'm looking for that. That's the very thing, because I don't want to see it run real quick into halfway point and above it, because then I'm wrong. What would happen if it did that, ICT? Would you trade short? No. I'm going to wait for a shift in market structure later on. Model 2022, something to that effect. Okay. Holy cow. What I just gave you is how you differentiate when you run and trade a turtle soup, which is what you watched me trade live yesterday. That's Turtle Soup. That's my rendition of a Turtle Soup. That is not the Street Smarts book written by Linda Rasch and Larry Connors. The inspiration, the understanding of a stop raid, I learned from that book. But what I teach, I call it, fondly, and it's a term of endearment, kind of like it's a nod to the influence. And I've never shied away from this. That book helped me understand how to trade a stop hunt. Whereas I never looked at trading with the view of going into the marketplace, trading with a stop loss of someone else as my entry mechanism. I always looked at it as a stop loss happening to me as a victimizing of me. That was the perception I had of it prior to that. So the paradigm shift I had by reading that book, Street Smarts, which I think every one of you should have. It's a wonderful book. It gives you the mindset of taking a model that can be extremely simple and only trading with these conceptual ideas applied to a very small set of rules and sticking to it, accepting that it's not perfect. And if you do that, regardless of whatever it is, it'll give you the foundation that's required to be a systematically, consistently profitable trader. Because you have to have a baseline somewhere, right? And I was in there doing all kinds of stuff. And that book gave me really simple little strategies. I don't like everything in that book, by the way. I liked the anti pattern when I liked using stochastic. I don't like stochastic. I don't like any indicator now. But it was giving me these little things that I could work with and study, where I had no idea what to go in and study. Like many of you see all these videos I have, all these tools, this terminology, this language, and it's overwhelming. You're like, man, where do I begin? Go to Model 2022 playlist. It's 41 videos. The first one is kind of like just building your expectations. It's boring. But if you really want to be a student, listen to it. And that will give you the foundations to go in and start looking for things that repeat every single fucking day. Every day it's there. And then if you want to learn a little bit more, watch the video I did for the silver bullet. It's one video. It's just one of them. And it'll teach you a time-based trading element that is very specific. It doesn't have a lot of moving parts, but it allows you to go in and start having something that you can measure progress in. You can go in and back test. Does it really exist every hour? I'm sorry, not every day between 10 o'clock and 11 o'clock? Yeah. But when I'm looking for a raid of buy side to sell into, which is scary, I know. When you first start trading, it's very, very scary to do that. Because how do you know it's not going to keep going? Well, that's why you use a stop loss. What? You're just going to trust it like that? Yeah, that's what 30 years does. 30 years doing something, you get a callous to it. You just don't feel the same fear and apprehension that you do as a new student. But I'm cognizant of it. I'm sensitive to it. And I teach you how to overcome it. But the idea of running into liquidity for the sake of fading it, using it as counterparty, handshaking with it, okay? That's what smart money does. I illustrated that to you yesterday. I outlined it. But these three specific price levels is what I was looking for. And the very thing I wanted to see was, number one, do we gravitate towards it? Yes, we do. Do we trade into it? Yes, we do. Do we reach the lower quadrant of it? Yes. Do we trade into the upper half of it? No. It stops short of it. Hello. That's exactly what smart money looks for. That's the waiting point. That's the billboard sign when you're driving down 95 and you're looking for the exit ramp for gasoline, the indicator that, hey, this is the time you got to take the initiative. You're low on gas. You got to go over here. It's the prompting, okay? Because smart money does not have fucking indicators on their chart. They are not looking at level 2 data. They don't have depth of market, ladders. They don't have book maps. They don't have indicators at all on their fucking chart. They're looking at time and price. High frequency trading algorithms are looking for this signature here that engage with the algorithm that books price, that controls price. It's rigged. It does what it needs to do based on a script. It's like a fucking video game. It has boundaries. It's not going to go here. It's not going to go there. It's going to do everything it's going to do in that range until manual intervention. Manual intervention will take it out of autopilot. And then you'll see this massive repricing higher or lower. What does it look like? How does that visible in price action? Rate announcements, unexpected rate announcements, non-farm payroll, CPI, all these big red folder events. They are times when they're signaling that, hey, the algorithm will do what it's going to do, but these are times when it's advantageous to us to upset sentiment or engineer new sentiment in the marketplace to inspire interest in a market or dissuade folks from being so interested in another market. Manual intervention comes in and they will manually reprice to a level. And that's why you see these sudden, like, what the hell just happened? That thing just moved 100 plus handles in 1 minute. Yeah, welcome to manual intervention. You can't trade that. You can't predict that. You can anticipate the season, the climate, the conditions where it will materialize. So I'm looking at a inefficiency that is not a zone. I'm taking that inefficiency and I'm dividing it into 4 equal quadrants. The highest high, the lowest low, the midpoint. Well, that's 3, right? And then you have, it's 5. It's 5 levels actually. Then it's the lower quadrant of it and the upper quadrant. Okay, so it's 5 very specific levels. But when I'm bearish, I don't want to see the upper half traded into. When I'm bullish, I don't want to see the lower half traded into. And if I'm watching a price run at a time on the economic calendar and it reaches into these inefficiencies, imagine how hard this would be to communicate in a book, by the way. And then not have the example of me doing it live yesterday. It's very, very complex, isn't it? And this is why I didn't write books sooner. Because it takes a lot to make it understandable. Because if I just tried to do what I feel I would have done if I tried to write a book only and not do it live in examples where you see me doing it, entering it with a stop loss, managing the positions. That's why I do all those short little vignettes on Twitter. So that way you can see that these things repeat. There's a logic behind it. I know how to trade. It can be transferred to you in logic. Using the same logic, you can do these types of things too. You won't be perfect. You'll lose money eventually. You're going to have losing trades. Everybody has losing trades. But you have to have something to base this belief in. You have to be able to, if it's believable, you'll spend more time trying to do it, right? And that's why I show the examples. And I try to teach you to trust yourself and allow for enough time for you to learn how to do it. But the aspect of it not getting to the upper half of that, that's important. That was the indication to me. It has nothing to do with a DOM. Nothing to do with a depth of market ladder. It has nothing to do with volume profile. Has nothing to do with Elliott waves. No, nothing Wyckoff. Nothing supply and demand zone. None of that stuff. It's this. This is what I'm talking about, and I'm challenging you. You will not see this anywhere else until I talked about it. It wasn't in existence. Okay. So when I talk about it and I'm very dogmatic and I sound like I'm bragging and I'm talking down to other traders, I'm defending my position because you have no idea how many times I'm getting emails from people that say, look, I found your YouTube channel. I like this, but I see this guy saying that you failed 4 times in the Robbins Cup, and that's fucking bullshit. I've never failed 4 times in the Robbins Cup, and I will beat your fucking ass, Vinny. If you please, just get your ass on the leaderboard and call me out. You won't do it because you can't fucking trade. Vinny E. Mini bitch, Vincent March of Allen, Texas. I will say your fucking name. I ain't too scared to say it because you're a little bitch. Motherfucker. Let's go. Caffeinated yet, motherfucker? So the buy side here was the attack. The target was the inefficiency. The indication that it's turning was that it didn't go to the consequent encouragement. Okay. It failed to go there. So now we can start dropping down to a 15-minute time frame. Oh, let me go back up to the hourly. I'm sorry. I forgot to mention this point. If you want to consider using the idea of the 15-minute and or 60-minute liquidity pools for draws, for intraday scalps or intraday trading, as soon as it went up into this level here, as soon as it did that, and we're bearish, and as I was outlining, I would be, and you should be expecting it to do that as a case study to watch it live yesterday. As soon as it did this, and if it starts to go lower, where would your focus immediately go to? Sell side. Where would that be resting at that moment? As soon as it did this, right there. I guess in a way, market replay would be helpful here because if I could have the candle looking like it was bullish right there, and it didn't have this down close candle already there, it would be helpful. But your eye should drop right to that low. That's where sell side is. Okay, and then it's this, and then it's this, and then it's this, and you have this inefficiency down here. Okay, so that's how you would note all the liquidity pools. As soon as the engagement of that fair value gap on the 4-hour and we get the failure to get to the halfway point. Now you can do this on higher time frames, but if I'm trading turtle soup ideas where I'm selling buy stops, I'm using this criteria right here. And my private students did not learn this before today. They're learning it just with you right now. All right, so when the price runs up, again, it fails to get to the halfway point. That's what this little pink level is here. So we're going to take this lower quadrant level off because it's already too many lines and it can be confusing. So it fails to get up there. On a 15-minute time frame, you can see it reaches up there, and then immediately we start to break lower. What's the 15-minute time frame showing you once it gets up here? Where's the first draw on liquidity? That low. Look how fast it goes to it. Boom. See that? Real quick. Then we start to chop around in here. Stop would need to be above consequent encroachment. Why that level? Because it's the low of the 4-hour inefficiency. It is the consequent encroachment of that wick. So there's what? There's 2 PD arrays. No, 3. This up close candle, that closing price is a rejection block. So it can punch up here to run above that and then reject price, go lower. But what happens if it wants to go past that? How far can it go? This is a confluence of 2 different things that are on the same level. Otherwise, I would look at this consequent encroachment of that wick. Why did I skip over that? Because some of you are like, oh, he just read my fucking mind. How about that? By the way, don't wear that shirt. It doesn't go with your pants. This consequent encroachment of this wick and the low of the 4-hour chart, fair value gap, that agreement of the same level, I'm going to use that over anything like this secondary lower consequent encroachment. But prior to that one, moving my way up, this rejection block, consequent encroachment of that wick and the low of the fair value gap, your stop loss needs to be above that. Okay, and you can weather all this bullshit here, and the market eventually breaks lower, takes another swing low out on the 15-minute time frame. That's a scalp. That's a high frequency trading trade there too, as a target. What is this right here? Sell side on the 15-minute time frame. Remember, we're looking at a 15-minute time frame. So all these levels are salient. There's significant draws for liquidity. So as I'm watching price, as you're watching price, you'll look to see, does it have a willingness to get down to these levels? And how does it behave once it gets there? This low right here is a sell side liquidity pool too. We see it draw into that. Then we see this inefficiency. All this drop down here, where's the fair value gap? From this low up to that high, where's the fair value gap? This one and this one. So if you were down here and you're watching it trade up there, you have to do what? Think about the logic I gave you in the 2022 model. If you have two fair value gaps, you have to allow for the market to reach into the higher one too. So yeah, you could have entered on this right there and it dropped down. You're probably thinking, rock star. And you had your stop loss right there. And then it came up and hit you, knocked you out, and then it ran. Logic is you have to allow for that secondary fair value gap. I needed to get stopped out. Otherwise, I would have did the whole range. Anyway, the market runs down, takes out the London low right in here, which is what I outlined yesterday in the live stream. So I said we were going to go up into this inefficiency at 10 o'clock, use that news driver to drop down and erase everything from the London low. And all this movement higher, they would erase that. It did. And for good measure, it's got this low and got real close to that one, didn't it? Doesn't look like it got it though. Is it equal? The low is 1125. And the low is, oh yeah, it did, just by a tick. There you go. That's enough for government work, right? And then off the low and then consolidate and goes into the close. So if you look at how on the 1 minute chart, all right, so it goes up and it falls short of reaching consequent encroachment of the 4 hour fair value gap, which is that shaded area up here. So as soon as the next candle opens, as soon as that next 1 minute candle opens, I'm in there. I'm selling short. My stop loss is placed. I trust everything. What happens if I get stopped out? I got stopped out and I'll look for a new entry. I was trusting that we were going to go down yesterday. And if I would have got stopped out, just like you've watched me do, I think 2 examples of it this year where I got stopped out in trades and re-entered using the same logic, or when I got stopped out, I reversed and went the other direction. So I shared me getting stopped out, okay? I've been stopped out in profit in some of them too, but I'm talking about where I've been stopped out wrong about what it is I was trying to do and still getting in and working with the logic or reversing it and finding another profitable trade. So I'm not fearful of sharing a loss. Excuse me 1 second. But losing trades and getting stopped out does not cancel the underlying premise behind why you took the trade. Now, not all the time. Sometimes it does. When it broke down here and it created this sell side imbalance, buy side inefficiency, as soon as it traded up into there, I added to it. That was a pyramid entry. So what about this inefficiency is good that we like to see? I'll give you a second. I'll look at it here while I get a drink. Remember, the context is we're bearish. We're looking for lower prices. What were we aiming for? A run completely over top of the daily ranges progress and what they've put in place since London's low. So this move from here to here is not the entirety of the move. This inefficiency here, we want to see part of it, just a portion of it. The upper part of it, we want to see it stay open. Okay? That's the full fair value gap. The sell side imbalance, buy side inefficiency, that drop here. That drop to be perfectly repriced. This is not balance. This is not a rebalancing of price. Okay. If it goes all the way back up and touches the low of that candle right there, that low, let me take this back off. That candle's low right there. If it touches that when it retraces, all that is a complete repricing. That is not rebalancing. Okay. The price is not rebalanced until it leaves that range. What does that mean? Here is the inefficiency. Price trades into the inefficiency and then leaves it. When does it leave it? right here. How do we know that? Because it moved away and took out the structure low that used the retracement into it. So it definitely left it on that candle. Then it came back and touched it here and had a little tiny little mohawk touching into it. One tick. Did it have an interest in getting back to the midpoint? No. That's wonderful. That means we're heavy. Also, more specifically, this was the original fair value gap, right? This is the portion that didn't close in and reprice to. What is this? So some of you, insignificant. You would never pay any attention to it. Wouldn't be anything of any consequence to you. It's just, whatever. Just never paid any attention to it, right? To me, that's a breakaway gap. It did not completely reprice to that candle's low. I like to see that. That signature is a algorithmic confirmation that we are going lower. We're going lower. And when we broke down on this candle here, see, when we look at it like this, when you're looking at price at like this, okay, it's hard to appreciate the fine details I'm showing you in this little area here until I point them out to you. But when you go back and look at all my executions, all the ones that I publicly recorded, you might want to go out and start downloading them now. So the details in here, once you start looking for them, go back and look at all my other executions and you'll see these signatures are there. I'm trading with this logic in mind. I like to see things delivered to a specific level, but here's another side of that. I like when the things that would be normal to see it trade back up to this low, to reprice to it, that would be an efficient market. Not inefficient, it would be efficiently delivered price. For it to completely overlap this and touch that candle's low right there, if it would have done that here or any of these candles, that would have been a completely normal function of an efficiently delivered price. But if we're bearish, we want to see it fail to be efficiently delivered back up to that level. Because if it does that, it's indicating by default that it is underlyingly weak. I swear to you, there is nothing on my fucking monitors that are telling me secret information. I'm literally reading the open, high, low, and close at specific times under the pretense that it should run to liquidity or inefficiency based on a narrative that I literally walked you through minute by minute yesterday live. That's what it is. That's understanding the market. That's understanding price. That's basically reading the future, predicting the future, reading the minds of billions of fucking people all around this spinning rock and what they're doing in this market. How are they going to perceive it? And what am I going to do against their perception?